Let's turn to a rate-sensitive sector, the financials. One of the best performers on the year, but worst performers over the last month. Erika Najarian is UBS's large-cap bank and consumer finance senior analyst and joins us now. Erika, 25 or 50, we're going to get a rate cut. What is it going to mean for your sector, and is it already reflected in the prices?
Yeah, so I think part of why you called out the underperformance and part of why that's happening is because now the market's grappling, what do these cuts mean? So we've now baked in more cuts into the yield curve, but I think investors are now starting to think, does this mean that there could be maybe not so soft of a landing that's coming up? And I think that's why the stocks had performed poorly. In terms of it being priced in, the Basel III endgame relief and some of these rate cuts may actually start to be pricing into the money center bank stocks given their outperformance year to date. But if we get 50, I think that actually could be good news for the mid cap stocks where commercial real estate had been the big issue. And so bigger cuts could be a sense of relief there.
Yeah. What about net interest income levels, though, if we get 50?
Absolutely. So the interesting part is money center banks tend to be more asset sensitive. That means they benefit more if the Fed is raising rates, whereas some of these mid-cap banks are actually liability sensitive, where their liabilities or their deposits reprice faster. So that's why that could set up really well for those SMIDs.
Yeah. Last week, we got a bit of news. We got Basel, it was lower cap threshold than had been anticipated, at least.
Yep.
That said, the stocks reacted badly. You also had some comments from Daniel Pinto at J.P. Morgan, sort of, kind of bringing in growth targets for investment banking and trading. What do you make of it all?
Yep. Yes, I think there was sort of a three-part whammy. The first is, look, we've been talking about Basel III softening since December of 2023. So in terms of being priced into the money center stocks, I think that started quite early. Second, it's never great when the best earner on the street essentially says, hey, consensus is a little bit too high on net interest income. And the read across for other banks is not so good, especially for someone like Bank of America and Wells Fargo. And third, from that same conference that Daniel was speaking from, we actually started to get, signs that the consumer is weakening. Now, a lot of those consumer weakening signs were coming from lower income, but I think there's fear in the market out there that might start spreading upwards.
But on the, and I know you, David, asked about the net interest income. It just feels like It's really hard for analysts and investors to forecast the troughs and the peaks here, given the changing rate outlook. And for so long, it was that higher rates are good for banks. It's better for profitability. And then it was like, you have to cut rates because these high rates are hurting the bank's financial performance. So what is the confusion around this area?
Yeah, Sarah, I think that's a great question. I'm not even penciling in the rate cuts until we have the yield curve squared away after Wednesday, right? So what that means is the buy side or investors are saying, my gosh, there's even more uncertainty over net interest income. And to your point on, rate cuts becoming, going from, bad to good, I think the biggest question mark here is what will deposit costs do? Because the asset side of the balance sheet is largely mechanical, right? The assets are priced off of the curve, off of SOFR, and that's largely, going to reprice relative to the index. But the deposit repricing is a business decision. And so does the bank sacrifice the volume in order to cut rates, right? Which also has an impact on net interest income, or do they cut rates more immediately? That's where the confusion is, because the deposit side ends up being a pricing decision. Now, over the short term, maybe the banks get a little bit more aggressive because there's not a lot of loan growth to fund. But then if loan growth picks up next year, then all of a sudden you're scrambling. So I think that's the dilemma in terms of not just what analysts and investors put into their models, but also strategy for the banks.